Okay, well, morning everybody. Some years ago the European Parliament had a dream. It was in Lisbon that they had this dream. Some people would say they're probably still dreaming. But the dream was about a financial services action plan. This was a plan to unify all the investors in Europe, to have the same sort of regulatory system for all the 25 member states. There weren't 25 then, of course, but for all member states. And the idea was also that any regulated firm in any of the states could passport themselves into any of the other 24 member states and put up their sign and carry on doing business. The other aspect, though, to the European dream was to create competition amongst exchanges. And as we'll see a little bit later on, the effects of what they did then are probably going to have a greater impact over the next few years than even they dreamed might have been possible. Now, their dream was known as the Financial Services Action Plan. Don't bother to look for it anywhere. You won't find it on the web. It's a concept. It's a unification concept. But to translate it into action, to give it teeth, what the European Parliament did was to create 73 articles. And these 73 articles form the basis of the Market in Investment Services Directive, MIFID, which is what we're going to talk about today. Now, there's been all sorts of costs bandied around as to how much MIFID will cost, and Silent have just come up with an estimate of euros 1.15 billion, which is a pretty sort of staggering sum of money for a new wave of regulation. And the interesting thing is that out of that 1.15 euros billion, some 400 million is attached to the market side. That is to say, the investment that people will have to make in terms of being able to connect with the new range of markets that the effects of MIFID are undoubtedly going to bring. Now, MIFID is not the only directive. There are other directives that have come out of Europe. There's the Market Abuse Directive, the Prospectus Directive, the EU Savings Directive, and one of the most complicated of all, the Risk-Based Capital Directive, known as Basel II, whereby banks and other institutions have to put up capital commensurate with their perceived level of risk. Now, we're not going to talk about any of these this morning, but Basel II is illustrative of the way in which the European Parliament and the Commission is worked. Because if you look at the history of Basel II, that started in America, where they were worried about the risk of a large bank collapsing and bringing others down, systemic risk. And they identified about a dozen of the large banks as ones that they had to have sufficient capital confidence in to cut down this systemic risk. That's fine, and that's running today. Europe took up this idea and said, marvellous. Instead of a dozen banks, most of which individually wouldn't even be in the American top 10, let's have all 6,000 institutions in this particular pot. And so all 6,000 institutions are now in that web. And that's behind the MIFID thinking. In America, the attitude is, here is what you've got, here's the regulation, caveat emptor. In Europe, it is, we know what's best for you, particularly as far as the retail investor is concerned. And as we'll see later on, this nannying is coming through very, very strongly. Now, there's a lot of confusion as to who are all these people that are making all these laws. And so let's just start with trying to demystify a bit of MIFID and show where it comes from. And we start with the European Parliament. European Parliament, of course, made up of MEPs, and the whole thing run by the Council of Ministers, the Gordon Browns and Tony Blairs of this world in the UK. But what the European Parliament did to translate this dream was to create a new directive, MIFID, with 73 articles. Now, these 73 articles are quite high level. Some of them are just principles, some of them are a bit more detail. But they're known as level 1 articles. And what they then did was to say to the European Commission, and the European Commission is think of it as the civil service arm of the European Parliament. They then said to the European Commission, look, here are these 73 high-level articles that we want you to translate into level 2 detail. We want you to put some flesh on the bones so that we can really have an in-depth set of regulations that can then be handed down to each of the home state regulators in the 25 member states. And to do this, they formed, under the auspices of the European Securities Committee, which is the workhorse committee of the European Commission. The ESC, note those letters because you'll hear a lot about the ESC quite shortly. The ESC got together a committee of European securities regulators, CSER, and said to them, we want you to turn these 73 articles into detailed rules. And what CSER did, it consulted very openly, and it produced 2 sets of directives just to split the thing up a bit, and these were published earlier in the year, the last one in April. So CSER has said, look, you've asked us to translate all this level 1 stuff into level 2, here it is, and there's a shed load of it. And in a minute we're going to be looking not at all 73 articles, because a lot of them really don't worry us, because they're housekeeping and so on and so forth. But we're going to be having a look at those ones that will critically affect every licensed member of the financial community in all 25 member states. So we're going to look at the ones that particularly affect financial institutions in the UK, but they will have a very similar effect to financial institutions everywhere. Now, CSER has published its advice, and that's gone back to the European Commission. Now, the interesting thing is that the European Commission has looked at some of this advice and said, we don't like it. It's too prescriptive, it's too detailed. You've gone completely over the top. And we saw quite recently the chairman of FSA, Callum McCarthy, saying, this is too complicated. It's going to cost too much. We say, well, hang on a minute, Callum. You were part of the Committee of European Securities Regulators that put flesh on the bones. And he will say, with his FSA hat on, we had to put flesh on the bones because the European Commission, in their level 1, forced us to do so. And so what we're now seeing is this very open debate between the European Commission on the one hand and CSER on the other hand, and our own Treasury joining in and saying, isn't all this too complicated? Now, the EU have produced 4 papers, or the ESC have produced 4 papers. I'll give you the references in case you want to read them. ESC 17, 20, 23 and 7. And the one in particular that will affect most people is ESC 23, which is the conduct of business rules, which covers the handling of clients and best execution. Now, what will happen is that by the end of September, this debate will have to have been reconciled, because the European Commission will be producing its 700-page draft on MIFID, 700 pages. Now, I would say that we know 90% of what is going to be in those 700 pages right now, and in view of the timescale, the message is get to grips with what's there now. Don't wait until end September to see the full lot, because you're going to have a lot of catching up to do. And if you understand what CSER has said now, you'll be much better equipped to see what changes there will be. Now, all parliaments have got to pass MIFID into their own statute book, in our case a subtext of the Financial Services and Markets Act, by October next year, October 2006. So all this has got to be put to bed in terms of any ongoing debate quite early next year, because the implementation date, which has already shifted once, it won't shift again, is now the 1st of May 2007. Any regulated entity who is not MIFID compliant by 1st of May 2007 will not be able to trade for their clients, and they may as well pack up business and go home. So it's quite a serious sort of thing. In our own case, the FSA, the Financial Services Authority, is currently beavering away with its new rule book. Now, its existing rule book has been around for quite a long time. People are fairly familiar with it, fairly detailed stuff. But if I tell you there's some 80 people right now sitting around at the regulator writing all this stuff, you're going to have to read it. And not only are you going to have to read it, but you're going to have to do something about it. It's estimated that the FSA draft rule book will also be a 700 or 800 page tome, and that'll be produced this November or December. So there's very little time to get things going. If we now turn and have a look at some of the MIFID articles that affect us. The first one we want to look at is the organisational one, which is Article 13, CSER Article 13. Now I'm going to go through these headings very, very quickly. So if you want to have a look at some greater detail behind this, we will draw your attention as to where you can find this extra detail. But for now I'm going to go very quickly. It affects every particular aspect of a firm, from compliance to finance to dealing to portfolio management to research to operations to IT. It's a unique case, unlike Y2K and other single industry objectives. This is a unique case where every aspect of an organisation is involved. And so you can't just park it as a project for IT. It has to be managed by each business in a very cohesive way. Because as you'll see, a lot of this is interactive. A lot of these things just do not stand on their own 2 feet. Compliance, what that says is it must be independent. Compliance must be independently rewarded. The remuneration structure must not reflect any particular department. So you can, compliance folk out there, you can breathe a bit of a sigh of relief. You can still get paid, but your bonus will have to come from the overall performance of the firm and not the department that you have a soft spot for. I was only joking, compliance people there. Internal systems, nothing new here except to say that you've got to have written procedures. You'll have to write everything down, make sure you can evidence it. Your business continuity plan must be written. Not only must it be written, but you've got to demonstrate that you've tested it. You might find that's a sensible thing to do anyway in this day and age. Outsourcing, what outsourcing says is that For any major contract that you outsource internally to a sister company, for example, you've got to treat that as an external contract. You've got to have a written agreement and you've got to know exactly what those terms are and be able to evidence it. And that's a major departure from the moment. There was a proposal, I say there was, it's still a proposal from CSER that there should be mandatory telephone recording of all dealers' conversations for 1 year. Now the Treasury have come out and objected to that, and the ESC are very lukewarm about it. And that's an example of a recommendation that may well go out of the window, but it hasn't at the moment. Safeguarding of clients' assets. If any firm looks after clients' assets, they will have to have a new two-way agreement by the end of April 2007 for 1st of May. Now, of course, most firms do look after clients' assets now in nominee accounts, and even execution-only firms, many of them insist on stock being held in their own nominee as a custodian. Investment research is the most contentious of this set of articles. Basically what MIFID is doing is being extremely beady about any in-house research that in any way, shape or form is seen to favour perhaps the corporate finance arm of a company. No longer will you see the glowing write-ups from the research department because a company is about to launch an IPO. MIFID has killed or will kill non-objective research. And there are also quite onerous rules around the conflict of interest policy in Article 4. I haven't shown Article 4, but if you look at CSER Article 4, you will find conflicts of interest set out. Now we move on to Article 19, conduct of business. Now Article 19 is very, very important, the whole set of Article 19, from the point of retail clients. Article 19 is all about retail clients, and a lot of MIFID is all about retail clients. So 19.1 says you've got to act fairly and honestly, as if it would say, you know, you've got to act dishonestly, but it thought it would get that in. And 19.2, fair, clear and not misleading information. Now that's again pretty obvious, but what it does do is highlight what you have to set, how you have to set out marketing material. You can no longer make extravagant claims about past performance and so on and so forth. That's going to be quite beadily watched. As far as Article 19.3, which is information to clients, is concerned, this specifies the content of information that you have to give to clients. It's quite prescriptive, it's a long list, so you need to look at it. Lots of it is what you do now, but some of it isn't. There is one wonderful suggestion from the European Securities Committee in their latest paper that some investors ought to sit an aptitude test. And in some way, by passing an aptitude test, the requirement for the firm to find out more information about them will be lessened. Well, that's certainly one of the most amusing things that I've heard. Perhaps some members of the ESC who proposed that should pass an aptitude test themselves. Probably not the best thing to say on a CD, but there we are. Know your customer's suitability, Article 19.4, and appropriateness 19.5 cause quite a lot of confusion. Article 19.4 suitability is all about portfolio managed clients. If you just remember that, it demystifies a lot of it. And Europe always assumes that a portfolio managed client is a discretionary managed client. There's no concept in Europe of an advisory managed client. like we have in the UK. So in the UK we have 4 types of clients basically: the discretionary client, the advisory managed client, where the broker knows about the portfolio and will advise the client in the context of the portfolio, the dealing with advice client, where advice is just giving on individual shares, and the execution only client. So know your customer suitability. That means you need to know as much as CSER says you need to know in terms of finding out all about the background to these clients to determine as to whether the client understands the nature of the service that you're going to offer him. That incidentally now also brings in credit loan agreements. The appropriateness test covers everything that's not to do with portfolio managed clients. So when a client comes on looking for advice, you have to decide from your knowledge of those client circumstances as to whether whatever you're advising is appropriate for that client. And if you don't think it's appropriate for that client, you have to say so. Not for you, aren't bored, too dangerous. 19.6 is the execution only area. Now, this is a pretty draconian set of regulations, and this is where the nanny state comes in. Because what CSER is saying to execution only clients is, we know what's best for you. You cannot deal in complex instruments. They're too complex for you. You can't deal in derivatives. You can't deal in warrants. They seem to forget that the average Joe public is quite happy to go into Ladbrokes and make a spread bet and understands perfectly well what margin means. But can he deal as an execution only client? Sorry, cannot do. There was a worry at one time as to whether the AIM and OFX markets were in the complex instrument category. But I think Jonathan will be able to, as he heads QCA, help convince us that that's probably now not the case. If we move on, the core of the whole thing is client agreements. There are different categories of clients under MIFID. There's the professional client, there's the retail client, and there are various classes of market counterparties, like other market makers, exchanges, and so on and so forth. And one thing that everyone will have to do is to map across from their existing client base to the newly defined CSER client base. Now, in many cases, retail clients will just map across, but the definition of a professional client will catch many retail clients. And so you will find that you will have a number of retail clients who get categorized because of the size of the business they do as to professional clients, when a lot of the protections of the Financial Services Act will be lost, and they will have to be recategorized back as retail clients. So there's a big job of work to be done in classifying the database. And for some clients, they will be in both categories. A professional client, for example, can be a professional client for some types of investment, but a retail client for others. So a lot of work to be done in the categorization area. And that's where a lot of the cost for retail firms will fit in, because they've got to send out new client agreements, because the new client agreements will have to contain best execution policy, conflicts of interest policy, and one or two other things that we'll see as we go along. The current debate is, will the clients have to sign these agreements? Because it's one thing to send out all this stuff and assume that the client's accepted it unless he or she says no. And it's quite another thing to have to get the signature back on that agreement and get that agreement back. As things stand, unless some of the rules are changed, for most clients, that signature will have to be on the agreement, or some durable method, perhaps an electronic signature might be okay. But in any event, the client will have to signify that he or she has accepted those terms. And if you haven't got that agreement back by the 1st of May 2007, not only will you not be able to trade for that client, but if you're looking after their assets, you'll have to give them all back. So pretty draconian. Reporting to clients concerns mainly unexecuted orders, and we'll have a look at limit orders in a minute. Now we come on to what is really the bridge between the client side and the market side, best execution. Now what Caesar says about best execution is that you've got to establish a best execution policy. They don't tell you what that policy has to be. They give you some guidance, but they say whatever policy you have is the policy that we're going to come and audit. And so what they need to see is a best execution policy that caters for the need, A, of different clients, and B, different clients dealing in different venues. So we're not just talking about one best execution policy here. We're talking about many best execution policies, an algorithm for each best execution set of circumstances. So Article 21 says you've got to put best execution arrangements in place. You've got to monitor them. You've got to know where the liquidity in a particular stock is. And we're going to come along and check to make sure that you're doing this properly after the event. You've got to notify clients of your best execution policy. You've got to keep your clients up to date with your major execution venues. So you'll have to think quite hard as to how you're going to do this, because the poor old client will have already been on the receiving end of the equivalent of the Yellow Pages directory that's dropped on the doorstep every year or so. I mean, the client agreement is going to have so many clauses in it. It's going to be, if not War and Peace, the first chapter of, and clients may not entirely welcome too much of this. And for some clients you'll have to obtain express consent. Now there's a confusion in my mind in the wording in the MIFID articles as to what does consent mean and what does express consent mean. Does express consent mean evidence by signature? Does consent mean if I don't object I've consented? That's my best interpretation. We'll wait and see what the European Commission says about it, because that could easily drive the complexity of all this client stuff that we will be sending out. Now, if we have a quick look at order handling, and I'm not going to go through this in much detail, but the Caesar advice is very, very prescriptive as to the methods that have to be employed and the data that has to be recorded. So I'll have to leave you to look at the detail of that. But one area that is one of these sort of little nasties that you sort of come across unwittingly, and that's client limit orders. On the previous slide I mentioned that there is a section on client limit orders where you have to report them if they haven't been done within a business day. But what this says, it goes much further. It says if a client limit order hasn't been done within the business day, you've got to display this to the wide world. So suddenly you can have a retail broker or an institutional broker, a fund manager, who's used to tucking away client limit orders and trying to execute them the next day or the next week. Now he's in the position of having to display that data to the world at large. So he's got to have some sort of display system or team up with somebody who's got a methodology to allow him to display his wares. And that's just a small example of how a quite innocent article can translate itself into very complex market practice. Transaction reporting is another area of very great detail. And again, now's not the time to go through that detail. But I would just mention one thing. This is where does liquidity exist raise its head. And as we'll see when we come on to the biggest article of them all, Article 27, in a minute, we'll see that liquidity and where liquidity is going to be places a major obligation on firms to keep track of where the market's going. At the moment, pretty well everybody knows that if you deal in Vodafone or Glaxo, BT, you deal on the London Stock Exchange, on the order book system. And it may well be that will continue for the foreseeable future. But if the liquidity in one of those stocks moves away from the London market, you've got to know where that liquidity is. And that's one of the side effects. Transaction reporting is not necessary for the exercise of options, conversion of convertibles, or the exercise of subscription rights. So now we come on to what is really the biggest article in MIFID. If you were to read all the other articles, it wouldn't equate to the significance and the complexity of Article 27, systematic internalizer. Now, what is a systematic internalizer? I'll read the definition. It's an investment firm which on an organised, frequent and systematic basis deals on its own account by executing client orders outside a regulated market or MTF, multilateral trading facility, to you and me crossing networks. Now what does that mean? Well, this goes to the heart of the European debate. Many members of Europe, particularly the French, wanted to have some sort of central market mechanism on the one hand, but equally they wanted the opportunity to create market competition on the other hand. And what Article 27 tries to do is to say exchanges have no longer got the right to assume that they are going to get all the liquidity in a particular stock. Because what they're saying is that if you, and this applies mainly to major houses now, if you have a lot of client business, you can cross it internally. You don't have to give it to the markets. So if client A is a buyer of Vodafone and client B is a seller of Vodafone, you can put the two together. You don't have to go to the order book, the Paris Bourse, Deutsche Börse, wherever the action may be. That's nice. But the quid pro quo is you've got to make it transparent as to what you're doing. So if you're going to set yourself up effectively as a mini stock exchange, you've got to act like a mini stock exchange and you've got to display your wares. We're talking about regulated securities here, securities traded on a regulated exchange. And you've got to be prepared to deal with the outside world as well. Now, this introduces a degree of complexity into the proceedings, because firms who want to be systematic internalisers are going to have to invest in pretty complex systems, because they've got to be able to trade with the wide world. Now, how many of these how many systematic internalisers are there going to be? I've heard estimates that range at the low end from 12 to 15, to an estimate I heard the other day of 500 to 600. I've heard that some European countries are insisting on a number of their members becoming systematic internalisers for political reasons. What those reasons are, I don't know. But what this means is that the concentration rules are now eliminated. This forcing of most of the business into the regulated stock markets. And again, there are estimates that something like 30 or 40% of business may go through the systematic internaliser route. A huge, huge chunk. Now that, of course, means that more trading will go off exchanges with significant implications for that. Perhaps that might speed up the possibility of a merger between LSE and Euronext if both sides are going to find less business. So it may have that particular effect. But certainly Article 27 is going to be the article that has the most fundamental change on the way in which markets work. Now Articles 28 and so on and so forth, I'm not going to go through. They deal with pre and post-trade transparency. So they put the flesh on the bones of, if you are going to be a systematic internaliser or a multilateral trading facility, how you have to display your wares pre-trade and how you have to report post-trade. The interesting thing about this, of course, is that whereas data at the moment exists in nice little repositories, you know, all the data for UK shares comes from the stock exchange, from the Paris Bourse, from the Paris Bourse. It's all nicely packaged and everybody can see the close of business, everything that's been done in a particular stock. Think about the effect of Article 27 when all this can be spread around the place. Who's going to collect the data? Because if you are the transactor in that stock, it's your data. And we know that data is a very, very valuable commodity. Who's going to police this? Who's going to put it all together? There are going to be big wins for some houses in terms of selling data. There's going to be big wins for IT houses that get involved in the collection of data. And indeed, there's going to be big wins for those IT houses that supply firms with order routing capabilities to meet the best execution requirements, which they will have to do by chasing around and finding where the liquid market is now. Now, just to finish up with some summary slides, which, in view of the time frame, I'll just leave up there so you can come back to them at your convenience. But in organisational terms, that's a summary of what we've looked at. We've looked at record keeping. We've looked at clients and the effect on these, and we've looked at market structure. So I won't go through all that again. But I'll just finish up by saying at the end of all this, we all might feel as exhausted as this chap on the slide. But be in no doubt that this is going to happen. There will be variations, but it will happen. And the clever businesses are the ones who will get to grips with understanding what it means, tracking the changes and updating their business plan to see how can we get the best of MIFID. Thank you.
As Michael said in his presentation, MIFID is a large and complex project. There is a lot of investment that is required. But also, at the end of Mike's presentation, he alluded to the fact that if you approach MIFID strategically, there are opportunities. So what is the size of those opportunities? Solent, in June, published a report where they stated that the total revenue savings due to MIFID were around 1.6 billion euros per year. That's a large figure. 72% of that is through internalisation, and I'll go through that a little later. The rest of it is made up of savings on market data through greater competition, an increase in market data revenues, and savings in exchange trading fees. One area that hasn't been considered within the Solent report is that of increased revenues due to passporting. Under ISD1, products and services that were authorised in one EU country could be offered across the whole of Europe, but the products and services were limited. Under MIFID, those products and services are every product and service that a firm is authorised for. This means that you can offer new products and services to existing clients or existing products and services to new clients, thus increasing revenues. But of course, there is a threat as well. The threat is that there will be new competitors within your traditional markets. Because of course, firms that are regulated in other EU countries can offer new products and services into your home market. Therefore, there is a threat and an opportunity, and a decision needs to be made as to how to approach that. Systematic internalisers. It's a big area, but also an area that again gives a threat and an opportunity. It gives new opportunities to offer new services, to offer better terms to clients through internalising trades, thus saving on exchange fees and on clearing and settlement fees. Thus there is an opportunity to offer better terms to clients. But it's also a threat because of course your competitors might well offer those services giving better terms to clients. So there's both a threat and an opportunity there. The market leaders are already preparing for MIFID. There is at least one investment bank that is already advertising MIFID compliant services for its clients, obviously hoping to increase market share and to gain competitive advantage. So there is pressure to take decisions on what a bank's response or a financial institution's response to MIFID is going to be. Because the longer it's left, the greater the threat, the less the opportunity. Of course, ultimately, if it's left to the 1st of May 2007, the threat is enormous because you won't be MIFID compliant. Therefore, there needs to be a decision taken as to what the response to MIFID is going to be. It's up to you. Are you going to go for minimum compliance, which implies just a cost to the business, or are you going to look at this strategically, which means that there can be increased revenues and new business opportunities? After MIFID, the world will change. There will be new revenue opportunities. UK and European firms will move into new markets. There'll be new insourcing, outsourcing opportunities. Therefore, it is time to take a decision. How are you going to respond to MIFID?
Good morning. I'm Richard Britton from the International Capital Market Association. It occurs to me, having watched and listened to, rather read, recent press reports, commentaries and so on MIFID, that it appears to have burst unexpected on us all in the last few months. I mean, nothing could be further from the truth. It's been a 4-year process, which is coming to its conclusion probably over the next 6 months. But it's been a remarkably open and transparent process across Europe. However, in the next few months, I would not want to bet against the proposition that when we get to the last few hours even of horse trading between the member states, the way Europe has traditionally fixed these things, particularly in the area of financial regulation, will come to the fore. So the outcome is by no means certain as we speak. But the process of negotiating MIFID has had some very beneficial side effects. It has completely transformed the way the debate on the development of legislation in the financial services area is being carried forward. It is now based on a transparent process with consultation every step of the way. 4 years ago, you would not have heard phrases like market failure analysis being used as the basis for regulatory initiatives. But that is now becoming commonplace. Market failure analysis where the industry is either unable or unwilling to correct the problem is now being seen as a core requirement. Similarly, 4 years ago, you wouldn't have heard regulatory impact analysis, perhaps a somewhat more subtle and less determinate form of analysis than cost-benefit analysis, but valuable anyway, becoming a core process. That is now being accepted, certainly by the Commission. Now, there continue to be skeptics about all of this amongst a number of legislators and regulators around Europe, but my sense is that the influence of the skeptics is waning. Unfortunately, the impact on MIFID has been rather limited, since these new techniques are only coming into fashion now towards the end of the MIFID process. And the major strategic decisions that Mike was describing earlier on were made some 18 months ago. But there is still work to be done, and there is a game to be played. And it's certainly what I and a number of my colleagues and a number of the other associations, and indeed a number of key players in the major firms, are going to be spending their summer and autumn working on. If ever the devil was in the detail, it is in the detail of MIFID. Let me talk a little about the prime concern of the International Capital Market Association, which is Europe's bond markets. Now, compared to the equity markets, the bond markets have come out of MIFID relatively untouched. The impact on bond markets over the near term is relatively small. Now, this was not an inevitable conclusion. There were a number of member states who wanted to see all the obligations on firms that are to be imposed on equity dealers that Mike was referring to be imposed willy-nilly on the bond markets. And at ICMA and a number of other associations around Europe, we lobbied very hard with the Commission, with Parliament, with finance ministries and regulators across Europe, pointing out the damage this might cause to the international bond market in Europe, which is one of Europe's great success stories in a global capital market environment. And we led a successful campaign. We overturned amendments to MIFID which were being introduced into the European Parliament, and we won the debate. But there was a price. The price was that the Commission has agreed to review all the transparency provisions in MIFID and report to Parliament and the European Council if the delay in MIFID goes through, in April 2007. But we have won some time. We won some time as a head of regulatory policy at one of the major European regulators said the other day. We've won time for the industry to develop solutions, for the industry to develop ways forward for the bond markets which enhance the efficiency of markets while ensuring the regulatory concerns that investors are protected and that the markets operate and are seen to operate with integrity. And that again is what we are going to be engaged on heavily in the next 2 years. ICMA, LIBA, and two of the buy-side organisations, the Association of British Insurers and the Investment Management Association, announced this week that we are co-funding two important pieces of research into the European corporate and sovereign bond markets. The sort of questions that we have asked the academics to look at is, for example, whether European bond markets deliver efficient outcomes, and if not, whether enhanced transparency might improve those outcomes. They will be looking at whether transparency will evolve naturally. In the OTC bond market, perhaps compared to the OTC equity market, there is already a lot of commercially driven transparency out there. And finally, of course, from a regulator's perspective, the most important question is direct statutory regulation necessary? Now, contrary to an article in yesterday's Financial Times, this is not aggressive lobbying on our part with a preconceived view of the outcome. We are approaching this, and we've asked the researchers who will be doing the work for us to approach these things with open minds. We do not know what the results of their research will be, but we are confident that those results will be of extreme usefulness in influencing and providing a basis by which the Commission, in the course of its review over the next 2 years, is able to come up with, we hope, sensible and pragmatic resolutions to these issues. Thank you.
Good afternoon, ladies and gentlemen. My name is Jonathan Eardley. I chair the Markets and Regulations Committee of the Quoted Company Alliance. Amongst my day jobs, I'm a partner in Share Witness with Mike, and we get involved in a lot of expert witness jobs. I am also chairman and managing director of Issues Direct. Mike and I are involved in a cost-benefit analysis for MIFID. My particular and primary interest is for companies, unlike Richard's, outside the Eurotop 300, namely the medium and small companies. And I think there are three main issues that MIFID is concerned with regarding these companies. Firstly, liquidity. Secondly, retail investor access to these companies. And thirdly, one Michael's already mentioned, research. These three issues are exercising me and my colleagues at the QCA, particularly at the primary business level, before we even consider the operational issues. And in particular, 3 points. The role of the retail service providers, the non-regulated markets, in particular AIM and OFEX, and also provision of research on these small to medium-sized companies, which, might I say, represent a significant proportion of the retail market in the UK and much larger amount than any of the other European markets. I'm delighted to say that we actually have made some progress in the last few months. It would seem that we are working towards a solution in respect of retail service providers such that they may be deemed to be on-market participants, which will get over some of the issues that potentially faced them and faced retail brokers in trading shares for their clients. We also seem to be working towards, and the stock exchange has some confidence, that AIM and OFEX, although they are deemed to be non-regulated markets, may also be included as non-complex instruments under MIFID. This is important because if they were deemed to be complex instruments, then certainly a number of the execution-only brokers and their clients would face signal problems in being able to trade these stocks. And it is very important for these clients in respect of their liquidity and ongoing trading that these execution-only clients are able to access these markets and these stocks. If either of these two issues, the RSPs and AIM and OFEX non-regulated markets, are not resolved, then they certainly will impact upon retail investors and where they can trade, and retail brokers, particularly those with execution-only clients, who will have to review and can reconsider their business models. As regards research, the third point I raised, then I think also there we will have to see how things evolve, but it is certainly clear that, as Mike said earlier, that the houses which actually provide research at the moment, particularly the corporate broking houses on small to medium-sized companies, will have to review their positions, and we may well see the development and availability of independent research, though how well funded that will certainly be an issue. I'd really like to conclude my remarks by saying that given MIFID and given the aspect of non-regulated markets, particularly AIM and OFEX, taking themselves out of the prospectus directive, whether a number of companies on the main list, certainly in the UK, will consider whether they should also move to these non-regulated markets to ensure that you get centralisation of liquidity, which is scarce anyway, but also to get out of some of the provisions. Thank you very much.
I understand that there are around 42 EU directives currently in progress or through into implementation, and these include the EU Savings Directive, Prospective Directive, Market Abuse Directive, Transparency Directive, etc., as well as MIFID. So how important is MIFID compared with the other 41?
I think in terms of the way it's going to make investment services firms change the way they do business, it's probably the most crucial one. The Prospectus Directive is primarily concerned about the obligations of issuers, as is the Transparency Directive. The Market Abuse Directive essentially is about criminal behaviour, which one would like to think that doesn't happen at all in most firms, and only happens in a minority of the firms a very small amount of the time. But MIFID is the day-to-day, each day, from the time you come in the morning to the time you leave the office at night, and even impacting on your firm on a global basis. So it is truly, I think, in terms of the investment services firms, the most important.
Isn't MIFID all down to interpretation at the level 3 stage, when the country regulators set the real rules for each national market? Is there really any point in examining all the turgid detail of the EU and the CESA documents as they are at the moment?
Shall I take that one? It's a very interesting point, because what we don't know right now is whether all this is going to be promulgated by regulation or directive. And there's a very important distinction between the two. Articles that are promulgated by regulation have to be effectively put in dot comma by all the 25 member states, so they'll just be copied down into the host state's rulebook. Articles that are promulgated by directive gives the host state regulator more license to interpret those directives. The concern that we have is that all the contentious ones will be promulgated by way of regulation, so there's no debate, and the non-contentious ones will be by way of directive. And I think the reason why that is, and a sort of a less facetious reason, is that the timescale is so fierce now that there's not really room for a second round of debate. Once, as Richard said, the horse trading has been completed, really that's got to be it. So the regulators have time to get this into the draft regulations.
Could I add, McCallum McCarthy last week, I think, said that the FSA's approach is going to be based essentially on sensible copy-out of the Level 2 regulations, which I think is why you need to look at them now.
Can I ask, in view of its potential impact, do you consider that MIFID has received enough publicity, and is there enough awareness of it?
Okay, I'll answer that. I think the answer is no, because the impacts on the business models, on the operational processes and the IT systems are enormous. Already time is running out to make those changes and to implement the changes, because there's less than 2 years before it becomes law. And therefore, firms ought to be aware, ought to be thinking of their response now. How are they going to deal with it? How are they going to make the changes? What are the changes? Even although the FSA haven't come out with the rule book, there is already sufficient detail and information to start making the high-level impact analysis.
Can I add to that? I think it is also useful that the FSA actually have embarked upon the cost-benefit analysis, which has enabled a number of firms to start to get up to speed about MIFID and to identify a number of the principal issues which, as I indicated, I think there are already starting to be sensible suggestions made as to how these rules and regulations can be implemented in a way which is not too damaging to investment firms.
Jonathan, what effect will MIFID have on the AIM and OFX markets?
This is quite an interesting area which I touched upon on my brief opening remarks. As you know, AIM and OFX are deemed to be non-regulated markets, and it is important, as I said, that the retail community, particularly the execution-only clients, are able to get access to these markets. There had been some concern that trading on AIM and OFX, or those shares, those instruments, may be classed as complex instruments as opposed to non-complex instruments. There is now a view within the stock exchange, and slightly wider than that, though it is yet to be confirmed with the ESC, that hopefully, as long as they are ordinary shares of companies quoted on AIM and on which are the subject of ongoing quotes from market makers, they will be deemed to be non-complex instruments and therefore will be capable of being traded by execution-only brokers on behalf of their clients. That certainly will have a significant impact and will enable investment firms to continue with their business model as they are. Were that not to be the case, and I do think we need to keep a very close watching brief on this in respect of the ESC and what occurs there, that if that were not to be the case, then it would impact upon those investment firms materially, such that they would then have to reconsider whether they could offer those services at all.
The panel has been extremely good at explaining what MIFID does, also its urgency, as well as explaining this is a very big project, as well as has laid out now that indeed awareness is very important. But given that it is a very big project with a fairly short period of time in which it has to be delivered, could you shed some light on what you regard to be the bottlenecks for lowest cost delivery within a short period of time? And those might be commercially driven, might be driven by vested interests, but I think it would be good to have some idea about what those bottlenecks are.
Yes, I mean, there are two sorts of bottlenecks, I suppose. One is the bottlenecks in terms of implementing MIFID. Is that one of the ones that you were responsible for? And the other is a bottleneck that comes from the political horse trading that is clearly going on as a sort of a slow-down procedure. I mean, to take the second one first, I mean, this has got to be resolved within a very finite timescale, because it's got to get into the parliamentary timetables of each country, and the time is already very, very short for this. In terms of where the pressure points may be, Certainly for the retail broker, the pressure point will be all about repapering. Now, we don't know if we're going to get away with one-way agreements right at the moment. But what we do know is that the client is going to have a shed load of new stuff to get, execution policies, conflict policies and all the rest of it. And certainly the indication is that where the firm holds assets in custody, there is still quite a feeling that we may not get away with the client not having to evidence in some way, shape or form that he accepts the new agreement. The jury's out on that. There's going to be a lot of debate amongst member firms. Our own position is, and our UK position is, very much against having to have signed two agreements. We don't see it's necessary. I think the Treasury may well support this. Other areas I think that will require a significant amount of evaluation are in the best execution area. Understanding where markets may be, where liquidity may be, getting systems in to be able to order route, to be able to evidence your order routing, to take snapshots of your order routing. I see that as a big area. And a third area that I didn't actually mention earlier, which will be important to firms with discretionary portfolios, is this area of benchmarking and having to tell a client up front what figure of loss are you going to make before you have to tell him. It assumes that you make a loss for every client. And as the wording currently stands, this means full attribution portfolio analysis. And I actually haven't come across a house that's managed to do this properly yet. So that's another area of concern for firms. But the bottlenecks, I think, will be all about realising what sort of systems, technology, procedures you need to put in and actually getting them in and tested in the time frame.
Yes, I think at present there's quite a number of firms who are actually waiting for the FSA regulations to come out before actually starting a project. The problem with doing that is that it actually gives a very short time frame to actually implement the systems and the changes that are needed. Because already, as I've said, it's a short time frame to wait another 6 months before even considering a project, cuts that time frame even more.
But I think, if I may add, to Mike's point about benchmarking and loss reporting, and particularly the execution-only recording of where you traded and that you've done it at best, is going to be a very, very significant systems issue above all else. And I rather suspect that a number of firms may take the view that hopefully it might go away, because if they haven't got unitary systems at the moment across their groups, they're certainly going to have to move towards that to achieve some of this, and it will be a very, very significant issue for them.
Of course, we have a best execution expert in our audience with Scott, who's got enormous experience of best execution over the pond. I don't know if we would run to Scott giving us one or two comments on Best Ex, because I personally have found what he's said to me privately absolutely fascinating.
Well, I think just briefly, one of the things that's important about best execution is how the policy ultimately is going to be enforced and implemented. Best execution is one of those things where you can't write a rule that will be ironclad and will apply effectively across all customers. And so it's important to build in enough flexibility, but ultimately it's going to be up to the firms to decide how they're going to use these systems to satisfy themselves that they are meeting best execution, but most importantly, when the regulators come around to inspect these systems and these policies, they have to do it with some meaningful enforcement tools in their pocket when they do that. In the United States, I think that's been one of the, we've been fairly successful, I think, with best execution in the United States, and it's the way that the rule was enforced more than the way that it was written that was important.
the obligations of the systematic internalisers, and more to the point, the costs of fulfilling those obligations, have been portrayed as the price that Europe is paying for the abolition of the concentration rule. It seems to me that will hit more in some member states than in others, and that it might actually provide some competitive advantage to the UK. Would the panel comment on that?
I think the Celent report is very interesting, if I understand it correctly, which is predicting a huge increase in revenues from systematic internalisation, which in a sense stands on its head the argument of many people in the City of London, which is the systematic internaliser regime will actually drive dealers out of these markets. Dealers would decide that becoming OTC market makers was simply not worth the risk and the expense and the inefficiency in terms of the market risk from having to disclose your quotes, the technical risk from having expenses from having to build the systems. But Celent seems to be taking precisely the other point of view, and I think that is quite a startling number, which might suggest that the equity dealers who, by and large in the UK, have been extremely hostile to Article 27 and its implications for their business, and indeed have been threatening to withdraw liquidity from markets, that we simply won't put our firm's capital at risk in these circumstances, may turn out to be misconceived.
But considering that we already do internalise in the UK, isn't that impact greater in continental countries?
Well, it is. It certainly will, because I think you are still unlikely to see, in most continental countries, you probably won't see a great change in the existing processes. So although the concentration rule will be abolished, most brokers will continue to simply route their client orders onto the local exchange. And to take the best execution point, for instance, under CSAR's own calculations, the exchanges in Europe, I think that includes the London Stock Exchange, have an enormous concentration of liquidity. So given the wording of both the high-level directive MIFID and the level 2 regulations coming in underneath it, given the flexibility in there, like for instance, you only have an obligation to do business on a venue where you can get best execution on a consistent basis, that is likely to mean, in my view, far from opening up the market, it will do what a lot of Europeans wanted it to do, which was to make sure that brokers can continue to do business in their traditional mechanism. London on the London Stock Exchange, Paris on the Paris Bourse, the Milan, and so on. It won't have, in my view, a market opening effect. It will set in stone the existing framework.
Interestingly, to what extent will it also segregate the Eurotop 300 from the other stocks? How far down the tree will the systematic internalisers be prepared to trade in terms of stocks? I think this is the more interesting question arising from this.
I agree with that. It seems to me that the major firms, the big global and pan-European investment houses, will stay in the systematic internalisation business. In some cases, they may increase that business. But indeed, I think it is the smaller dealers who don't deal in the market necessarily every day, but might get caught if the definition goes the wrong way and the definition is still not set in stone. And those people who make markets in the smaller companies, where you may have to hold positions for a longer period of time, your risk exposure may therefore be somewhat greater if you have to publish quotes on a daily basis. I suspect it is precisely there that if you are going to see a reduction in liquidity, you are going to see it in the smaller stocks. So again, it's one of these classic regulatory conundrums, the law of unintended consequences. Those issuers whose stock is already liquid will probably see more liquidity, and those issuers whose stock is relatively illiquid and would need more liquidity will see less of it.
And I think we leave it to the audience to determine at what level that actually that cut-off might occur, because I think it could be quite a high cut-off, because about 12, 15 years ago there was quite an interesting study done for the London Stock Exchange which indicated that there would be 3 levels of market: a Euro interprofessional market, into which I think this naturally falls, a UK market, and a equivalent of AIM. And I suspect actually what's going to happen is probably the UK market may well move in some strengths down towards AIM. But that is speculation on my part entirely.
I mean, one of the things that we at ICMA have been trying to do, and a number of other associations, and I would certainly urge firms in other jurisdictions who might be viewing this tape, is to argue very strongly the case for phased implementation. This is speculative, it is high-risk regulatory change. Rather than going for a big bang approach in which maybe 500 or 1,000 European equities are subject to these rules on day one, why not start with 100? Review it, or even 100. Review it after a year. If there's no damage, add another 200. If again there is no damage, add another, and do it on a staged basis. Europe is very bad at doing that. The United States has done it, for instance, in the trace mechanism for introducing post-trade transparency in the bond market. Careful, staged. If things go wrong, you can reverse it. If there's no damage, you can increase it. And that, I think, is the message that we have to try to get across in Brussels and in the European Securities Commission in their deliberations over the next 6 months.
MIFID creates a very complex pan-European regulatory landscape, and it may also lead to the creation of some elements of pan-European market infrastructure. Will it ultimately be necessary to have a pan-European regulator to run all this?
I think that may be the intention, that we end up with some super regulator, and I've long suspected from some of the utterances behind the scenes that that's not an idle objective, although I think it would be heavily denied in Brussels. But I think it very much depends on how the regulation comes down. If it comes down very heavily by way of regulation as opposed to directive, I mean, put it this way, if 100% came down by way of regulation, you could say that every home state rule book is going to be identical, and therefore, by de facto, you've got a single European regulator, really. The more rules come down by way of directive, of course, the more licence the home state regulator has, and the less likely we are to end up with a single regulator. So I think this question is what is going to be a directive and what is going to be a regulation is actually very important, and we'll know that quite soon, by the end of September.
I'm assuming that institutional fund managers who either don't have retail clients or always place orders well above the standard market size are unaffected by MIFID. Am I right? And could you also clarify that I'm right in thinking that standard market size is the same as London's normal market size?
The retail market size is set at €7,500, which is about half the average retail client in the UK. So it's set much lower. And to answer your first point, yes, it doesn't affect the market professional to anything like the extent of the retail client when we look at the impact on client agreements and know your client suitability and all that sort of side of it. But where, of course, it does impact the market professional seriously is the areas of Article 27, where systematic internalisers, where the liquidity is going to be. Best X, you still have to demonstrate Best X for professional clients as well as retail clients. So I think you can look at MIFID in two parts. The client side mainly, the domestic client side mainly affecting your retail clients, but the market side really affecting everybody, with the professional clients really vying for where they can make the most out of MIFID.
The standard market size is not the same as the current standard market size in London. It's based on liquidity, and there'll be a variable range of market size, standard market size, anything from €10,000 up to the current CSR advice on about €75,000, depending on liquidity. It's an entirely different calculation. The key thing is not so much the fund managers, as I think Mike rightly says. The buy side is largely unaffected by that, but it's the sell side. If you are a dealer, for instance, if you're a market maker who only deals with major institutions, and all your business is in orders above standard market size, then you will be outside Article 27. Similarly, you get a real obscurity of MIFID. There is recital 53, which again excludes certain types of over-the-counter business, which is largely seen to be essentially interprofessional. Certain types of interprofessional business will be outside the scope of Article 27. And now one of the debates that's going on in Europe is just what does that recital mean? Because some member states would like to see really all business captured by Article 27. Other member states would like to see a very small proportion. So how that integrates with the text is going to be quite an interesting one, but there's still quite a lot to play for in terms of what's going on there. I think what fund managers may well find, because one of the oddities of Article 27 is that it means that you can't offer price improvement to retail clients, and you can only offer price improvement as a dealer to institutional clients in certain circumstances, is that fund managers may well have to work out with their dealers just what sort of conversation they want to have to ensure that the dealer, if the dealer says, I can offer you that stock at 95, and the fund manager says, I'll pay 93, he wants to be in a position where if the dealer wants to do the deal, he can do that. And there will be a certain amount of standardized conversations, I think, that will have to be created to enable that to happen.
Okay, we're going to have to, in the course of time, we've had loads more questions to go through. What we will do is put the questions that we've been unable to pose to the panel. We'll list them, and they'll go on the film or as an addendum. But one final question for all the panel to answer is that there is a very low awareness in the market at the operational end of the market at the moment on MIFID. City Compass researchers received some very worrying noises from the market at the operational level. And one of those concerns is that because of MIFID's political ambitions mixed with the regulatory, the compliance and the operational, that it will be postponed or delayed or rewritten in some way. We'll just go through the from one side to the other. Can any of those people have any hope that MIFID will be rewritten radically or anything that changes the effect of MIFID, or will it be postponed? Jonathan?
Like Michael, I think it's highly unlikely that it will be postponed. I have indicated already that I think there are some workarounds being discussed in detail to actually mitigate some of the more difficult and tendentious provisions, and they seem to be quite pragmatic and quite practical. Therefore, I think there will be some changes as perception rather than in actual text.
Richard?
It won't be postponed. It's already, assuming Parliament accepts the amending directive the Commission has just tabled, it's going to be delayed from April next year to April 2007. That is the most that we can get. I agree with Jonathan. Under the McCreevy role at the DG Internal Market, there is some moves, at least. There is a philosophy which believes in simplifying, and at the level 2 measures, to make them rather simpler than CSAR had originally proposed, and indeed that is where we are all working on. But I think that will be determined by the end of this year, January, February at the latest, and after that it is done and dusted.
Thank you, Richard. Stephen?
There's already been quite a long consultative period on this, so I cannot see it being delayed. Certainly other laws are not normally delayed. I would agree that I think there might well be changes in the details, but I think the fundamental text will remain the same.
Thank you, Stephen. Mike?
Yeah, I know it won't be changed. I mean, 1st of May 2007, that's it. I mean, you can regard that as a sort of in the same league as Y2K.
Okay. Clear enough, I think. I think City Compass now would like to thank the panel for their efforts this morning, and please, audience, thank them in the usual way.